Warren Buffett, the legendary investor, has been cashing out many of his positions and he's now sitting on a record pile of cash. 325 billion to be exact. And this is more than ever before in his career. Warren Buffett's moves have always been a sort of crystal ball for the investing community. And now that he is sitting on such a large amount of cash, many of us are wondering, what is Warren Buffett knowing that we don't? In this video, I'm going to break down why Warren Buffett is potentially sitting on so much cash, what this signals to the rest of the market, and how you can potentially prepare for what is about to come next. So this could be one of the most important videos that you're going to watch this year. So stay tuned and watch all the way until the end. And before we get started, make sure to smash the like button. And if you enjoy watching videos like this one where I break down complex topics in the world of investing, then also make sure to subscribe to my channel because I'm going to be posting regular videos like this one to help you to get an edge in the market. And of course, nothing that you see in this video is financial advice. Everything is based on my own research, my own opinions, my own worldviews. Before making any financial decision, always do your own research and or consult with a professional financial advisor. Now, let's get going. So, a major stock market crash could be looming, guys. One of historic proportions, at least if you're looking at the record cash pile that Warren Buffett is sitting on right now. So, maybe you've seen the movie, The Big Short. In this movie, they follow the story of Michael Burry, which is a fund manager, and he basically discovered the flaws in the financial system in 2007, 2008, when banks were betting on mortgages and they were making mortgage derivatives, and all of it was becoming one big bubble that was soon going to pop. And Michael Burry saw this happening and he placed a very big bet against it, and the bubble didn't pop right away the moment he realized. It took quite some time for the bubble to pop. But when the bubble popped and the market crashed, and the 2008 crash is known as one of the most intense crashes in history, Michael Burry made a lot of money, many billions. And these fund managers, they have a lot of, analysts working for them, and they constantly monitor the market. And oftentimes they have insights that the average person doesn't have access to. And this comes with experience. It also comes with connections. It comes with having the right team of quants, analysts, and putting that all together and having the experience of writing multiple different waves in multiple different asset classes. And yeah, as a result, Michael Burry made a lot of money. If you haven't watched that movie yet, I highly recommend you to watch it. It's a very inspirational movie, The Big Short. The question is a very similar scenario playing out in front of our eyes right now? Not with Michael Burry, but with someone else, Warren Buffett, which is known as the GOAT of investing. And GOAT is an acronym that stands for the greatest of all time. So let's quickly talk about Warren Buffett. Warren Buffett is the founder of Berkshire Hathaway. And Warren Buffett has grown his net worth to $150 billion. So this is a person that's in the Forbes list, richest, most influential people in the world. And what I mentioned, he grew his company, Berkshire Hathaway, which takes active positions in companies like Coca-Cola, Geico, the insurance company, and many other companies, banks, Apple. Later on in this video, we're going to actually look at some of the positions that Berkshire Hathaway is taking. But they grew it to $1 trillion company. And as a result, Warren Buffett became super wealthy. So one of Warren Buffett's rules for investing, and there's a very famous quote which embodies this: "I will tell you how to become rich. Close the doors and be fearful when others are greedy, and be greedy when others are fearful." So why is that relevant? Well, we just entered a phase of the market where people are quite optimistic. Gold is at an all-time high. The stock market is at an all-time high. Crypto is at an all-time high. President Trump just got elected. And there's a lot of euphoria around that. Elon Musk is going to enter the Elon Musk is going to play a role in the government with DOGE, the Department of Governmental Efficiency. So there's a lot of optimism right now that in the next few years there's going to be a lot of very positive developments in the market. So people are anticipating that, and the stock market is rallying, investors are positive, and that's generally quite good. But what Warren Buffett says is that during such times, you should not always do the same as everyone else is doing. When everyone is greedy, then it might actually be a great time to take a step back and have a look at what's really going on and whether you're really making the right move. So that's what we're going to discuss in this video. That's all based on Warren Buffett's philosophy. If you've been following me for a while, you know that I study Warren Buffett, I follow his principles, and I always think it's important to follow the smart money. This is someone that has been around for a very long time, for many decades. He has been in the market for so long, he's experienced so many cycles, and cycles have lots of similarities. You like to believe that every cycle is different or every asset class is different, but actually when you've been in the market for so long, you start to see a lot of patterns. So here, this article by Business Insider is saying Warren Buffett is building the Noah's Ark of rainy day funds. Here's why he stacked up more than $300 billion. So if you know the biblical story, Noah's Ark, then you understand that Warren Buffett might be building out his emergency fund so that he can go on a shopping spree when the market crashes. That's his way to turn the market crash into a very big victory. But in this previous article, they said $300 billion. By now, it's actually a lot more because Warren Buffett has sold a few big positions, and we're going to dive into those positions in a bit, but they're now sitting on $325 billion worth of cash after he sold a lot of Apple stock. Here again, a Bloomberg article, Berkshire Hathaway's cash pile reaches record $325 billion. So all of these financial publications are writing about Warren Buffett. Warren Buffett is known as the Oracle of Omaha. Literally, whenever Warren Buffett does something, people listen, people watch, people analyze and learn. And that's why I'm also making this video. First of all, for me to reverse engineer how Warren Buffett is thinking about the market. And secondly, to help you to get educated and to also understand this way of thinking. So let's have a quick look at Berkshire Hathaway's holdings of Q1 of this year. So the biggest holding of Berkshire Hathaway, Warren Buffett's company, was Apple stock, actually. And if you know Warren Buffett, he actually has a rule of investing. He generally doesn't invest in tech stocks. He doesn't like tech because it's too disruptive, too innovative, and he likes to invest in companies where he can say with a very big likelihood that those companies will exist in 100 years from now. So he doesn't like to invest in companies like Tesla because Tesla is a first mover, and oftentimes first movers aren't the actual companies that will remain dominant. For example, Nokia was a first mover. They created the cell phone market, and then nowadays you have Apple actually, which is a second mover, and Samsung or Android. Like those are the big phone manufacturers or operation systems. Same with Kodak. Kodak created the market, but then Canon and all of the other big camera brands took over. So Warren Buffett is not very fond of first movers. He likes to work with established companies with a strong moat, strong reputation, and a very big likelihood of surviving. So he invests in boring companies like Bank of America, like American Express, or Coca-Cola, Chevron, Occidental Pete. To be honest, I don't know what that is. Kraft Heinz, Moody's, and a few other companies which make up a smaller percentage of his portfolio. But Apple was for sure his biggest holding, and then the second two are Bank of America and American Express. Now, let's have a look how that changed over a period of around 6 months. So Apple got trimmed to almost half of its prior position. So it had 40% allocation to Apple, and now it's around 26%. So they took a lot of profits on Apple stock. American Express is now the second largest one with 15%. There you go. And Bank of America still around the same. So American Express got bigger. Mostly they sold a lot of Apple stock. So that's very interesting. Why would Warren Buffett sell their Apple stock? Let's have a closer look at that. Because I think understanding that might give you a lot of really useful insights. But before we do so, I just want to give you a feeling of how big the cash pile is that Warren Buffett is sitting on right now. So 325 billion. And here you see the history of Warren Buffett's cash pile. So in 2004, 2005, 2008, they were sitting on roughly $50 billion. 2008, it was a little bit smaller because they probably used some of the cash reserve to buy some new companies when the 2008 financial crisis happened. Actually, we spoke about that in the introduction of this video, The Big Short. And then the cash pile started to increase over time to a record amount of 325 billion right now. So to give you some context, 325 billion, that's equal to the entire market cap of Starbucks, Ford, Twitter or X, the New York Times, Target, and Zoom. All of that combined is the amount of cash that Warren Buffett is sitting on right now. He could buy all those companies cash right now, and it's actually less. That's all of those companies combined are 299 billion. He's sitting on almost $30 billion more. So that gives you a bit of context of how much cash they're hoarding right now. If Berkshire Hathaway's cash reserves were a country, it would be the 46th largest country in the world, right above Finland and just below Chile. Again, that gives you a little bit of context of how big the cash pile is that Warren Buffett is sitting on right now. And that might be a very important sign that a massive market crash of historic proportions is looming around the corner. So after studying Warren Buffett for a few years, I know that Warren Buffett is a very logical person. He understands that the market is dominated by emotions, particularly the emotions of fear and greed. Now, Warren Buffett has created a set of tools that helps him to analyze whether he should get out or in of the market and whether the stock market is priced fairly or undervalued or overvalued. And one of those indicators that Warren Buffett uses is the Warren Buffett indicator. So over here, you see a chart of this indicator. So the blue line, that is the S&P 500. And then you see the red line, that's 2 standard deviations away from the historic trend. The orange line is 1 standard deviation away and above, sorry. So let me rephrase that. The orange line is 1 standard deviation above the trend line. The red line is 2 standard deviations above the historic line. And then the green line is 1 standard deviation below. And then the dark green line is 2 standard deviations. So what are standard deviations? The market is volatile and it goes up and down. It oscillates. It moves up and down. So standard deviation in the world of statistics is an average unit of volatility which is within the normal range. So when you are 1 standard deviation below, it means that the market is cheap. It's undervalued. When you're 2 standard deviations below, it means it's a market crash and it's extremely undervalued and basically everything is selling at a Black Friday discount. When you enter the orange territory, it means the market is slightly overvalued. When you enter the red zone, it means that the market is very overvalued. And if we zoom in here on this picture, according to this chart, we are very much in overvalued territory. And generally, when you see that, when you see this happening, is normally a sign that we see a big market correction. So, for example, in the 1970s, we saw a correction when we crossed this red line. Again, in 2000, this was during the internet bubble times, we saw a big correction after we crossed the red line. Here, more recently, in 2020, when a lot of money was printed during COVID times, we saw a little bit of a correction and then it rebounded. And now we're crossing the red line again, meaning the market is overvalued. In a case that the market is overvalued, two things can happen. Either the underlying economy or the underlying businesses improve better, they become better, or the market corrects down to reflect the real value of the underlying company. So either the underlying fundamentals improve or the prices go down to reflect the reality. That's the only two corrections that can really happen. So what we have seen over here, the blue line, that is a chart of the Buffett indicator. What is the Buffett indicator? The Buffett indicator measures the total value of the US stock market compared to its annualized GDP. So if you take all of the companies on the stock market and you take their value, so the stock price multiplied with the value of that stock, that gives you the value of a company. And if you take all of the values of the companies on the US stock market combined, then you get the total US stock market value. Then the annualized GDP, what is that? That is the economic output of a country. So the actual economic output of the country. Here's the thing, the stock market is not the economy. The stock market is simply the values that people assign to companies. But that can be based on fear and greed. For example, the price of Bitcoin can also go up and down in a very short period of time. That has to do with fear and greed, how optimistic and fearful people are in the market. So what the Buffett indicator does, it divides the total stock market divided by the actual economy. And this gives you a number, in this case 208%, meaning that the stock market is way too overvalued right now. And that is probably why Warren Buffett is expecting a market crash of historic proportions. So why does this matter? Again, here a quick description. The Buffett indicator expresses the value of the US stock market in terms of the size of the US economy. If the stock market value is growing much faster than the actual economy, then it may be in a bubble. So historically, that's what we usually see. So whenever we cross the red zone, but it doesn't necessarily mean that it has to be instantly. So here you see that for almost a decade, the stock market has been very close to the red line. So the real question is, are we going to experience this market correction next year? Probably not. Are we going to experience it the year after? Maybe. Or the year after that? Maybe. Or maybe we need to see some kind of world event that triggers a correction, like a potential World War III or an escalation of the Russia-Ukraine conflict. We don't know. But more about that later. Then there's also another chart, which Warren Buffett also looks at, which is the inflation-adjusted S&P 500 with a trend line. So if you plot all of the data points of the S&P 500 in a chart, and you take the trend line, which is the dotted line here in this chart, then you see that it's actually exponential over time. So it tends to go up in a curve. Now, again, the market, the S&P 500, tends to oscillate above and below the trend line. So generally, when it's below the trend line, it's undervalued. When it's above the trend line, it's overvalued. And when it's a lot above the trend line, it's extremely overvalued, and it generally means bubble territory. So here, September 30, 2024, the S&P 500 is at about 71% above the long-term trend line. So that is very high. Yeah, so here you see it again with standard deviation. So right now we are 2 standard deviations above the historic trend line. And if you look at previous moments when that happened, that was in 2000, that was the dot-com bubble that popped, and in the 1970s. So yeah, generally that's quite a very big sign that a massive market correction could be around the corner. Then we have the Shiller PE ratio. So what is a Shiller PE ratio? PE ratio stands for price to earnings ratio. It basically means the multiple that we put on top of a company's earnings to determine its stock price. So let's say that a company makes $1 million of profits. Then according to the current PE ratio, the average PE ratio is that we're putting a 38 times multiplier on the earnings to determine its stock value. So if this year I'm making $1 million in profit, then my stock will be probably worth 38.29 million on the stock market. So that is quite a high multiplier. Historically, the average PE ratio is somewhere between 15 and 20. And when it goes above 15 to 20, it normally means that the stock market is overvalued. So 15 to 20, that's a normal PE ratio for a normal company. Tech companies tend to have a little bit higher PE ratios. They can go to 30, but on average, the PE ratio is 15 to 20. And now we are at 30 times the earnings on average. So that is super high. But this might not be an actual real good representation of what is really going on in the stock market. Because the stock market, and mainly when we're talking about the S&P 500, because the Shiller PE ratio is looking at the S&P 500. And the S&P 500 is a basket of the 500 largest companies traded on the US stock exchange. And the S&P 500 is a weighted basket. So based on the market cap of the company, so the overall value of the company, different weights are assigned to the S&P 500, to this basket of companies. And that gives a little bit of a skewed reality, because there are 7 companies, we call them the Magnificent 7, which are the 7 biggest companies in the S&P 500. They are tech companies, and they have generated most of the returns in the S&P 500. For example, Nvidia stock went up with 239% in 2023, last year. Meta stock went up with 194% in the past year. Tesla stock went up with 102%. Amazon stock went up with 81%. Alphabet stock with 59%. Microsoft stock with 57%. Apple stock with 48%. And the overall return of the S&P 500 was 24%. So if the 7 largest companies have such high returns, then the rest of the stock market must be performing really poorly in order for them to end with such a low average return. So the Magnificent 7 are generating most of the positive returns in the S&P 500. So when we're looking at the S&P 500, it's not only giving the real story. It means a few companies are doing really well, while the majority is performing very or maybe even negatively or really bad. So it gives a skewed reality. So just to give you an understanding of how big the percentages or the weights of these companies are within the S&P 500 index. So Apple stock made up around 4.5% of the S&P 500 in 2019, and recently in Q1 of this year it made up around 6.5% of the S&P 500. Similarly, Microsoft made up around 4.5%, and in Q1 of this year it made up around 7-something%. If we look at Nvidia made up less than 1% in 2019, and it made up almost 4% of the entire S&P 500 in Q1 of this year. So if you add up all of these companies, let's see, 6.5%, 7.5%. So I'm just simplifying over here. That is 14% plus another 4% is 18%. Plus another, 2%, 20%, plus another 1%, 21%, plus 4%, 25%, plus another 4 is 29%. So just these 7 stocks make up around 29% of the entire S&P 500. So when they are generating such high returns, again, it skews the reality. It doesn't mean the stock market is doing really well. It means that these 7 companies are doing really well. So if we look at Apple's PE ratio, you see that Apple's PE ratio, so the price to earnings ratio, meaning the multiple that you pay on top of Apple's earnings to buy its stock. That's around 39 times. And generally, it should be somewhere around 15 to 20, can be slightly higher for a tech stock, but now we are approaching very high numbers, very high multiples within the market. So that might be one of the reasons why Warren Buffett is cashing out on some of these Apple stocks. So he's taking some money off the table because the valuations in tech stocks, or Apple, which is his main tech stock, are very high. So he's taking off some of it off the table because he's seeing that the market is overvalued. There are many signs like the Shiller PE ratio, which is way above its 15 to 20% average PE ratio. The standard deviations above the trend line are also approaching overvalued territory. The Buffett indicator showing overvalued territory. So all of that are signs. And generally what happens in the market is that the market tends to move from periods where we call it risk on to risk off. Right now, we're entering a period in the market where we are very risk on. We are in a crypto bull market. Money is very cheap. The money printers all around the world are on. Stock market is at an all-time high. Gold is at an all-time high. Real estate in many places are at all-time high. So the market is very euphoric. So people tend to take excessive risks during these periods. And that's when they start to use leverage, borrowed money, to get into the most risky investments because those grow the fastest during times of risk-on markets. But after periods of risk-on markets, we generally tend to rotate towards risk-off markets. And different types of investments perform better in risk-on markets and risk-off markets. So in risk-off markets, you like to invest in more boring companies like, here you see it, energy, staples, healthcare. So here you see sector rotation. So that's what I'm pointing at right now. The reason why Warren Buffett is most likely taking so much profits and hoarding so much cash because he is preparing for a sector rotation. He understands that different stocks perform really well in different periods in the market. And he understands that now he needs to shift from a very risk-on investment like an Apple stock, which is a tech company, to probably a very boring and stable and steady company, which performs really well in a risk-off period, such as an energy company, staples, healthcare, utilities. So Warren Buffett, like I mentioned, Warren Buffett has been around for many decades. Warren Buffett has seen bull markets, bear markets in different market cycles. He has seen different governments, different environments, with war, without war. Trust me, this guy is very knowledgeable. It isn't without a reason that they call him the Oracle of Omaha. And people really look at what Warren Buffett is doing. When Warren Buffett gets into a stock, there is a secondary effect where a lot of Warren Buffett devotees or people that admire him or follow him also start to buy his stock. When he takes profits, they also start to cash out their position. So they know that Warren Buffett is oftentimes on the right side of the stock market. He understands the patterns that keep repeating over time, because when you zoom out, you see a lot of these patterns repeating over time and time again. So I hope that this video gave you any good insights in what is currently happening in the market, why Warren Buffett, the greatest investor of all times, is now cashing out so many of his positions and is potentially preparing for a massive market crash in which he is going to make money by rotating to a different sector which performs really well in such a market environment. So after hearing all of this, I'm really curious. Let me know in the comments below. Do you believe that in the next years we might see a market crash of epic proportions? And do you believe that Warren Buffett the fact that Warren Buffett is hoarding so much cash right now means that he is preparing for a massive market crash. And yeah, I'm also curious, what is your game plan? Are you preparing potentially for a market crash, or are you going to ride this risk-on market environment all the way to the top? But then if that is your game plan, make sure that you have an exit plan as well. Or on the other hand, if your game plan is just to invest for the long term, you just dollar cost average into the market, buy the S&P 500, buy Bitcoin, and you decide to hold over time, I do believe that that might be a very safe investment strategy, because most people are not traders. They don't want to be sitting behind their screen all day monitoring the markets. When exactly is it a good time to cash out or to cash in? It is proven that over time dollar cost averaging is just the easiest, simplest, most effective way for the largest group of people out there that aren't professionals. So yeah, I hope that you enjoyed watching this video. If you did, make sure to smash the like button so I know that you got good value out of it. And if you haven't done so yet, also make sure to subscribe to my channel, because I'm going to be posting regular videos like this one to always help you to stay informed about what is going on in the market and how you can position yourself for maximum profits. All right. That being said, peace out, take care, and I will see you in the next video.